Good evening, Bernie. What's up? It's me, Kadero Hudson, the wing man. I'm here to deliver that sauce. I'm bringing you guys that fire content. You know why? Because I love chicken. I love tacos, but most importantly, you guys know I love to deliver this delicious finance content. I am here to talk about financial management, financial planning, how to make wealth and make money not only in the stock market but through e-commerce. How to start a business, making money through online business, and I'm here to help you guys. That's why I'm the wing man, and I have a jam-packed video for you guys today. Yes, I'm American, and these going to be some shocking statistics for you guys as Americans, but do not fear because I am your wingman and I am here to help you guys along this investing journey. And yeah, so before we start, make sure you like and subscribe to my channel. Show my channel some love because guess what? I'm showing you guys some love. So make sure show your boys some love, man. Not only do you like and subscribe to my channel, make sure you watch the video from beginning to end. And I'm about to deliver some value to you guys today. Today's topic is basically data shows that Americans are horrible at investing and that basically they only normally on the high end are able to get 5% annual return. That's it. Americans are horrible investors. Hmm. Do you guys believe in it? Do you guys believe that you guys are horrible investors? Do you know how to invest? Yikes. So I don't know. I don't know you guys out there from Adam, but if you guys need any help with investing or help getting more than 4%, 5% annual returns, do not fear. I am here to help you and unzip it a little bit, free up my neck. I'm here to help you guys a little bit along the way. So let's talk about a few statistics that are alarming. That kind of shook me to my core. 42% of Americans have less than $1,000 in savings as of 2022. The average American savings account balance is 4,500. Okay, let's get that up to $10,000. Between 1959 and 2022, the average U.S. savings rate has been 8.96. David Ramsey and a lot of other financial planners and wealth managers and wealth planners states that in order for you to be effective in your financial planning, that your savings rate, your investing rate, should be roughly starting out 15% and getting up to at least 20 to 25%. 20%, 25% is tough. So when you look at videos or when you talk to a certified professional and get professional advice, they say roughly 20%. The average household savings rate in the U.S. was only 5.1% in the second half of the 2022. And in total, the gross personal savings in the U.S. is worth $2.3 trillion. The average American household savings is $41,600. A considerable 10% of Americans have no savings. 58% of Americans have less than $5,000 in savings, and then it goes through there, right? So, but the alarming one right here is that the 42% of Americans have less than $1,000 in savings as of 2022, and that the savings rate is 8.96. All these statistics matter, and I'm going to tie it in the end. So right here we have a chart, and in this chart it states right here. So why are Americans having horrible rate of returns? It is because let's just talk about it. So this graph right here shows that even missing just a few days in investing in the stock market, it can dramatically undermine your portfolio rate of returns. So a performance of a $10,000 investment from January 1st to 1999 to December 31st of 2018, if you were fully invested, a person on average got 5.62%. If you miss 6 of the 10 best days occur within 2 weeks of the 10 worst days, you got 2.01%. If you miss 20 of the if you miss 20 best days, you got a rate of return of negative 0.333. And if you miss 30 best days, oof, you got a rate of return of negative 0.235%. So, yeah, that kind of sucks. So, shout out to the Motley Fool. Shout out to the Motley Fool because I get a lot of my information from stocks, growth stocks, crypto, investing content from the Motley Fool. It really put your boy on. So, with the Motley Fool, it says so right here: the average American investment returns and how you can do better. So, remember to start out, it says that the average American investment returns normally it's around 5%, in which that's really subpar. Should be getting around 12% or more, or around 10% or more. I put it out there, but 5% is a travesty. So it says you may be surprised at how awful the average American investor return have been. Here's how to better that average. So it says, wait, the average investor does how badly? So according to the 2015 quantitative analysis of investor behavior, right here, let's see, right here, told you, boom. Well, I said 5% right here. It has it at 5.5%. So it has it right here that the average equity investor receive around 5.5%. So they gave you a little more. I said 5%. But the S&P 500 average return is 13.69%. So that's a difference of you leaving 8.9% on the table. So then also, that's on a 1 year basis. On a 3 year basis, you're getting like 14.82. 5 years, 10.9. 10 years, average of 5.26. These are horrible annual rate of returns. The S&P 500 has been average on the 3 year 20.41%, 5 year 15.5%, and then 10 year 7.67%. So as you see, the difference between what the S&P 500 is getting and what people are getting is a travesty. It is a travesty. So what is to blame for this poor performance? So in the report, Dalbar identified 9 self-destructive behaviors exhibited by investors that have contributed to the dismal performance. Let's talk about it. So common sense tells us that the goal of investing is to buy low and sell high. But thanks to our emotions, and that's for all investors, thanks to our emotions, we tend to do the exact opposite. When the market goes up and up, that's when investors pump the most money into stocks and funds. And when individual stocks have huge winning streaks, investors see all of their friends making money and buy shares at highs. Sure, as an investment like Tesla Motors, when the stock was at $20, would have been great. But chasing stocks into $200 is the exact opposite. So buying low, and I mean, if you want to sell high, cool, but just buying low, not all the time trying to buy it at the top. So 4 ways to better the average. Don't try to time the market. Don't chase hot stocks. My professional is don't try not to invest at the top all the time. Another advice for me: dollar cost average. Oh, that's number 4. Dollar cost average. Rather bi-weekly, monthly. Right. Don't panic during crashes, and most importantly, when the stock market does crash or when the stock market does experience those red days, buy. When people are running from the market, you buy. When people are running to the market, like right now, since the Fed has paused the federal interest rate increases, the market has been going up. So instead of not putting no money into the stock market right now, it's best just to nibble just a little bit, dollar cost average. Don't put too much money in. But then when it's on more red days, that's when you put more money into the stock market. But always be buying, always put money into the stock market to work, because a lot of stocks also pay dividends, and so those dividends help as well in terms of your total return. And above average returns are easy to achieve. The average American investor has produced dreadful investment returns over the past 3 decades, but you don't have to be average. Good investment returns don't require any sort of magical formula, just the discipline to recognize your emotional weaknesses and take them out the picture. And then, most importantly, also, another reason why people or Americans receive below average returns is because, and that's for me as well. I've been investing for 6 years, and what we tend to do is that we try to want to beat the market instead of riding with the market. And so, what I mean by that is this. So, I've included 2 ETFs for you guys to write down to invest into. These two investments is it mirrors the S&P 500, and it's like VU, but it's a equivalent variance of VU. So IVV is iShares Core S&P 500 ETF, and basically, if when you buy the S&P 500 ETF, and you buy, let's say you put $200 every 2 weeks or $500 every month, and you're doing this, and you staying consistent, your dollar cost average. So you're buying. Sometimes you're buying at the top, sometimes you're buying at the bottom, but your dollar cost average, right? And like you said in the previous examples, to keep your emotions in check, don't freak out. When it's red days, you buy more. When it's green days, you still buy, but just buy a little bit, but you're still putting your money to work. What happens is that, just like when new investors like myself, is that when I first started investing, I tried to want to beat the market. And so I bought all different type of growth funds and whatnot. I was trying to reinvent the wheel. And most importantly, I wasted roughly 3 or 4 years of investing because I was trying to beat the market compared to just dollar cost averaging and just buying the market. And as you see, when you buy the market, you will get, when you buy the index, you get market annual returns. And receiving market annual returns is not bad. A lot of times I was like, oh, I want to beat the market. I want to get 18, 20% annual returns, and kind of find out some years I will definitely will get it. Other years I will fall short by a lot. And yet the annual returns of the S&P 500 is just cranking out 12%, 14%, 15%, 12% annual returns. And so a lot of big reason why a lot of people deliver subpar annual returns is because, one, when the market drops, so they buy at the top, and then when the market drops, they sell. So that ruins your portfolio rate of return. And then you have the mentality like me, when you have ego, try to want to beat the market, and a lot of times it's best to buy the market and then buy other stocks around it to just help the returns, like Tesla, Apple, maybe Microsoft. But at least buying the market and having it as a core holder, that's one of the big mistakes that a lot of people tend to do. It's most importantly like what I did. And here's another S&P 500 SPY. Costs $402, and all you have to do is dollar cost average into SPY or into IVV every 2 weeks, every month, $250, $200 bi-weekly, $500 per month, and you will make money. Your portfolio will grow, and you don't sell, you don't freak out when it's red days, when the market is falling, when it's like everything's going bad, and Jim Cramer's like boom, 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 bear market, and people's like, oh my God, I don't know if I'm about to lose my money. Oh my God, the market's been going down for 3-4 days, 2 weeks. Buy. That's when you double down, triple down, you buy more, and then when the market, like right now, when it goes up and like people just is euphoric and the greed level is high and it's like, woo, you still buy, but just taper back. So if you was going to buy $600 worth of stock, buy $300 worth of stocks. Just you still put your money to work, but you try to limit how much you're trying to put in at the very tippy top, but you still put your money to work. So hopefully you guys enjoyed this delicious, wonderful content that, yes, us as Americans, we have an ego problem. we are, for the most part, are not saving enough. Our savings rates are not enough to hit our goal of 100K, 300K, $1 million portfolio. We also are receiving subpar annual returns, and that's all because we need to control our emotions, control our greed, and also control our pride. And then most importantly, we need to just dollar cost average and just buy the market, buy S&P 500. And if you want to get creative and exposure to more riskier stocks, you can. But make sure you have the market S&P 500 index fund as your core position. So hopefully you guys learned something, and hopefully I deliver that delicious, wonderful fire. Like and subscribe to my channel. I'm out of here.